Hello everyone, this is PR talking to you on September 22nd. And I have quite a few charts for you today, so I decided to provide a video in this format so that you see my screen and see me. Also, I can use two hands because I don't have to hold the stick with the phone in it. And I would like to start off with the question that I received recently. Is gold going back to 1840s once again? And my reply is that it's probably not going to happen, but I'd say that it is something that's possible. Okay, let's take a look where gold is. It's in the 1780s. And it's moving back and forth in today's pre-market session. No big changes so far. So for gold to rally to 1840s, it would need to rally back up over here. All right, this might create another lower low, and it might be in the cards. It would not invalidate the similarity to 2013, but I don't think it's that likely. Why? Because, well, we already saw quite long consolidation around the 1800 level. And based on the similarity to 2013, gold should be making lower lows, lower highs. All right, we are probably somewhere, well, you can see the similarity when I flip the charts over here, right? It's basically the same pattern. And, well, when you look at it in this way, it's pretty obvious that what we see right now, the back and forth movement, this thing, is analogy to this pattern, and that's what's most likely ahead. Okay, that's the part that you don't want to miss. Most likely, I definitely don't want to miss it. And exactly the part we are in right now, since gold did not move yet to the previous lows, is this consolidation right here, most likely. So the question, is gold going to 1840s once again? Could be similar to a question asked back in 2013. Is gold going back to 1700 once again? Okay, it was there once, it was there twice, and it almost moved there for the third time, but those who were waiting for this level to be reached, they never saw this taking place. Instead, what we saw was a fake rally that then turned into a much bigger decline that took gold over, over $100 lower in a relatively short period. So are we going to 1840s once again? Perhaps, probably not. And even if I wouldn't adjust anything with regard to the trading position that we have right now, because this move is too risky to take it into account. What is key here is not to miss the big decline. Well, definitely not to miss the biggest decline over here. Yeah, but you don't want to miss this one as well. What is going on right now is not only that the pattern, the self-similar pattern is being repeated, is that well, it makes sense also in terms of analogy to what we saw in 2020. At first, before the big slide, gold didn't know how to react really. It moved back and forth in a rather erratic manner. But when it finally decided what to do, then it plunged without looking back. Right, and we saw the slide from 1700 to 1450 in a very short period of time. And well, we did see that minor stocks truly plunged, and so did silver. And if the general stock market is about to decline in a profound way, and it is likely to take place, then, well, it's not really important if gold is moving back to 1840s in the very near term. That's taking into account what's likely to happen, the big deal. That's okay, that would be a $60 rally, but compared to what's likely ahead, that's just price noise. And again, based on the analogy 2013, it's not that likely to happen at all. Okay, the third top was not at the previous two tops. All right, having said that, let's take a look at what silver did yesterday. Silver moved higher by 41 cents, which seems bullish until you realize that it was actually the third consecutive daily close below the previous 2021 lows. So yesterday's session was not bullish, it was very bearish because it confirmed the breakdown in terms of the closing prices. This is bearish, not bullish. This opens the way to much lower levels, probably close to the $20 level or even lower, as the support provided by the proximity of the $19 level is even greater. It stopped silver several times previously, whereas the September high close to $20 level was not that strong. But it's a round number and it's close to the well, never mind that. So anyway, I provided the target as a range because, well, a lot could change. It will be best, as it's mostly the case, to take a look at gold for indications. So let's see what happens with silver when gold declines to its previous lows. I can easily see the scenario in which silver is then below $20. Actually, if gold declines from here, if you look at the size of the decline so far, it would decline much more than it already did, right? So if silver does exactly that, declining much more than it already did, and it's declined significantly, then the $20 to $19 level would be a great fit. While we're discussing silver, please note that the white metal is declining after topping very close to silver's very long-term turning point. So this decline has legs. It was likely to happen. It's not something that came out of the blue. That's well, something normal at this stage, where the silver market is, where the gold market was, where mining stocks are. So more declines are likely on the horizon. Okay, for the medium term, of course, I do expect silver to move well above the previous highs in the following years. Right, this chart even includes next upside targets based on the Fibonacci extension technique. They are close to the $80 level and then $120 level. Will they be reached? Most likely yes, in my view, but not shortly and not before we see a profound decline in silver prices. Will they be exceeded? Also yes, probably, but again, not without seeing a decline first. Let's compare the current situation to what we saw in 2008. All right, if you knew that you are at this point, okay, what would you say that silver will do? Is the outlook bullish or bearish? Well, for the next few months, it was bearish, very so. But if you took a more long-term approach, then, well, even if you bought at that time and you waited for your investment to at least double in price, you would have gotten that in less than a couple of years. So is the outlook bullish right now, or is it bearish? Well, it depends on what time frame you're discussing. And it's pretty similar situation to what we saw at that time. So it's a matter of individual preference, how one wants to act on that, and on this analysis, on other factors that one can read or see for themselves in other places on the internet and in other sources. My choice is to short the move right now, because not in silver but in mining stocks, and junior mining stocks to be precise, because, well, this move is so likely to take place. If it wasn't for the myriads of confirmations that I see on these charts, I wouldn't have probably entered a short position at all, or I would be writing about the long-term bullish upside or whatever. But these factors are there. I cannot pretend that they are not there, and I will not be quiet about them. It's my duty to you to report things exactly as I see them. So that's what I'm doing. All right. Ending this digression, I think, let's move to mining stocks. What mining stocks didn't do is actually quite important. What they didn't do is that they didn't rally back above the previous lows. There was no invalidation of the breakdown in terms of the daily closing prices. The GDX was up by 2 cents yesterday, so pretty inconsequential. It was basically flat. And comparing this to what gold did, it moved higher by $14.40. We see that mining stocks refuse to follow gold higher. This is very bearish. This is in tune with what I've been writing for weeks or months now. Miners are simply very, very weak relative to gold. And zooming in a bit, you can exactly see that there was an attempt to move above the previous yearly lows. That was unsuccessful. Miners moved back down before the end of the session. Also, what's interesting is that, I previously marked the similar situations early August and early September, and the follow-up is also quite similar. I even wrote up, or I did say that in a video. I don't remember how I conveyed this information. But I wrote or told you that the situation of miners could repeat itself. So we could see some back and forth movement that we also saw after the breakdown below the neck level of the previous head and shoulders pattern. And, well, we are seeing some back and forth movement right here. As GDX moved below the previous yearly lows. So it's normal. It's not bullish, it's normal. Especially that, well, gold rallied so significantly and gold miners didn't. What about juniors? Juniors are not at their new yearly lows, but they are very close to them. While GDX moved slightly higher yesterday, GDXJ moved slightly lower, and it declined more than GDX did also on Monday. I wouldn't view juniors' performance as anything bullish. Probably the only reason why they are not at new yearly lows is that they declined so significantly in August. They are well below the previous yearly lows as well. Please note how that GDX is breaking, it already broke below its March lows, right? And let's see how well below them GDXJ is. Okay, over $3 lower. So I continue to expect junior miners to be hit particularly significantly and to decline more than senior miners. Okay, and I can't help myself. I have to feature this chart because it's so important, and I don't want anybody to lose focus on what's really important market-wise. What we see right now is the history being repeated. The back and forth movement in the stochastic indicator even confirms that, okay, the fake buy signals is what we saw in early 2013, and it's what's happening right after the verification of a breakdown below the broad head and shoulders pattern. Exactly what also happened in 2013 before the biggest slide. So the implications here are extremely bearish. Speaking of early 2013, let's keep in mind that I already talked about this analogy with in gold. All right, in early 2013, that's what happened. This third lower low, right? And well, it's likely that we'll see some third lower low. Even if we see it at close to $1,800 level, it won't change anything. And miners might not even rally based on that. They ignored or mostly ignored the recent rally in gold, right? Well, you can see it over here. GLD ETF rallied quite visibly. The GDX ETF didn't really rally significantly. Taking these two closing prices, it's a move lower. In the GDX, it's a move higher in the GLD. Okay, but at this time, you might have a question about whether or not we want to trade in and out of the HUI Index. I mean, well, not the index itself, but individual gold stocks or GDX ETF, GDXJ ETF, or their leveraged counterparts. Well, let's see how good idea it was in 2013, which is being repeated to a significant extent. That's what's happened before the big slide. And the areas that I marked on the chart, the days that I marked, represent the rallies that probably would have appeared exciting if they happened right now. Okay, these are the moves where gold stocks rallied sharply. They even opened much higher. Okay, so they would probably trigger responses, especially on investment forums, like the decline is over, all to the moon and stuff like that, right? Back up the truck and similar messages. Yeah, all of those probably. And looking back at those days, it's crystal clear that these were actually the moments to add to the short positions at that time. These were practically the worst times to exit short positions and or enter long ones. Yes, buying after a rebound is one of the useful strategies for many markets, for many approaches, especially for day traders, intraday swing traders, or all sorts of markets. But we are in a situation where gold stocks are very likely repeating their performance in 2013, and it's clear that at that time it was one of the worst possible strategies to try to time each and every rebound. If one insisted on doing that, then it would have made sense to try to estimate or guesstimate where the market is already too oversold, and then exit short positions and enter long ones. So perhaps here, perhaps here, perhaps here. But the upside in this case was relatively limited, and the risk in being wrong was huge. Okay, what if you already thought over here that the situation was oversold? Right? Think about it. It's been declining for weeks. Compared to all the recent history, that was very oversold, right? Mid-February. But it turned out that it wasn't even a short-term bottom. the short-term bottom happened on the very next day, and the rebound that you wanted to benefit on was smaller than the daily decline that followed your entry point. So it was extremely risky to try to time those corrective upswings. And if you look at what actually followed, let's stick with this. Let's keep this in mind, the mid-Feb session. Okay, it was over here. What actually followed was a decline during which miners' prices erased over a third of their value. Okay, that it would have been a terrible decision to exit the short position on this day, and even worse, to enter a long position. All right, so does it mean that we don't want to adjust the position at all? Not necessarily. Okay, as risky as it might be, there might be some cases where it is justified from the risk-reward point of view to very briefly adjust the position. And I marked two such cases in 2013. It was after the HUI Index of gold stocks declined over 20% in the short term. So taking the recent high to from the recent high to the final low, from the recent high to the final low, when they declined more than 20%, then it made sense to perhaps exit the short position, and even for the less risk-averse people to enter long positions. Will we attempt that? It's a tough call. It depends on what kind of confirmations we get, what we don't get, what happens in other markets, what happens in the USD Index, how will the general stock market perform, what happens to its individual sector. For example, financials often lead the rest of the general stock market. Or the tech stocks. What happens then? What happens there? What happens in silver? Will silver outperform gold stocks? I mean, the decline outperforms, so silver declines more than gold stocks will. If that happens, if we see these combinations, then perhaps, only perhaps, will we go long or exit short positions in the short run. Because the really big deal is, again, not to miss the big slide. Right? Finally, on this chart, we see a rectangle. The rectangle is a bit over 3 months long, and it ends at an important bottom. It was not the final bottom for the entire decline, but it was important enough to really view it as the end of the big slide. Okay, that was it's this bottom. Why did I mark it? Because based on previous declines in stock market, if they were huge, then gold miners tended to decline for about 3.5 months after the top. And that was true even in 1929. If the history repeats itself, gold stocks are likely to bottom in mid-December or in December in general, because this predictive technique is not that precise. And if this is the case, then these final 3+ months have already started, 3.5 months. So perhaps what we see over here is going to be somewhat similar to what's about to take place. So we might indeed see huge 20% plus declines, and therefore it's important to be on the lookout for those opportunities to perhaps adjust the position. Okay, and also seeing this kind of decline will be, the 1 over 20% will be one of the clues that I will be on the lookout for with regard to timing the final bottom for this huge decline. So the moment where we actually go along with the long-term investment capital. So like the buying opportunity. Right now, it seems most likely that it's going to take place this December. As always, things can change. Things do change on the markets. Unexpected events take place. Black swan events in particular could change quite a lot. Well, by definition, of course. So I will be monitoring the situation. I will report to you accordingly. But that's most likely based on what we have right now. Let's take a look at the USD Index. Now, yesterday, in yesterday's premium analysis, I wrote that the USD Index formed a daily reversal, which could trigger some weakness in the near term, but that it was not that important because of the more long-term implications that are very bullish. And, well, what happened yesterday is that the USD Index did decline initially, but it moved back up before the end of the day, ultimately ending at only 0.06 index point lower. In other words, while we previously saw a bearish reversal, yesterday we saw a bullish reversal, which kind of nullified the bearish implications from the previous day. So at this time, it seems that the rally in the USD Index could simply continue. But even if it doesn't, even if we see more consolidation here, and even if gold rallies to 1800 or so, it's not what matters. It's the bigger picture that matters. All right, and finally, the last but not the least, the S&P 500 chart. Yes, it declined so far similarly to how it declined previously. It didn't even decline as much on a percentage basis as it declined last September, and it was nothing to really worry about, as it turned out. But something has actually changed, something very important, and I want to emphasize that. What I marked with dashed lines here are the short-term bottoms that we saw since March 2020 low. So after the general stock market doubled its valuation. Well, not market capitalization, but I mean the value of the S&P 500 index from about 2,200, and it moved well above 4,500. And during this time, there was no situation where it even briefly confirmed a breakdown below the previous low. All right, there was one attempt in May 2020, only on an intraday basis, and then stocks rallied back up. So that was an exception, actually. So they were like, I marked 1, 2, 3, 4, 5, 6. Actually, I should have marked this one. 7, 8, 9, 10, 11, 12, 13, 14, 15. There were many cases where we saw short-term bottoms, and each subsequent bottom was higher. Now, what happened recently is that finally the general stock market declined below the previous low. After these 15 declines, it finally happened. Things are different this time. And if that wasn't enough, it wasn't just a single day event. Yesterday, we saw an attempt to rally back up, analogous to what we saw in May 2020. Back then, well, the S&P 500 rallied back up. But this time it didn't. It just tried to, but it ended this session, well, 3.54 index point lower, but so not much, but it's not the side of decline that matters, it's the lack of the comeback that matters here. So the breakdown here is being confirmed, and today we might get the third close below the previous lows, meaning that the breakdown will be fully confirmed. It's already somewhat confirmed. Some people prefer to use the 2-day rule. I prefer to stick to the 3-day rule. But again, my 3-day rule is designed for the precious metal sector. And this is the general stock market. So in this case, the 2-day rule might be more appropriate. I haven't researched that thoroughly, so I don't want to say which one is better in case of this particular market. But that's not the main point. The main point is that something happened that hasn't happened before, and it already was confirmed by one extra day. And the last time that we saw something like that was in late February 2020, right before the decline started. I mean, the real decline started. So is the decline starting here right now? I mean, a huge one? Perhaps. But the size of the decline it's not what really matters to us, the precious metals investors and traders. What matters is that the general stock market has probably topped in early September. And if it topped in early September, it means that based on the analogies to the previous declines, the timer started. I mean, the 3.5 month timer started. If it did, then we are likely looking at the mid-December, or in December in general. It's not that clear. Or even early 2022, it wouldn't be that surprising. But we are likely looking at the start of the stage where the decline is getting clearer, where the decline in the precious metal sector accelerates, and when our profits on short positions in junior miners are getting bigger, huge, very huge, enormous, gargantuan, and then even ridiculously big. So yeah, that's what this chart says. Basically, it probably started. If stocks decline even more at the end of the week, visibly lower, then we will have the full confirmation. So far, it's already very bearish. All right, so this ends the chart discussion of today's video. And yes, it's a long video, I know. That's why I chose this format. And that's not the end of the video either, because I want to reply to the questions that I received recently. And here they are. I'm going to read them again anyway. I already replied to the first one about the 1840. Let's go going back to it again. Another question: what are some proxies for palladium? Well, I like gold and silver. I also like palladium. I was thinking it might be a good idea to have a mix of PMs. Well, some proxies for palladium are the palladium bullion, palladium futures, maybe palladium options, but well, it's not that much of a proxy. It's a specialized, relatively sophisticated speculative instrument, and the PALL ETF. These are some of the proxies that you might want to use. Again, I think that palladium as well as the rest of the precious metal sector is likely to decline in the next few months. But of course, it's your capital, you're free to do with it as you wish. One more thing that I would like to add here is that different ways of ownership of palladium would be analogous in the differences between them to different ways of owning gold or silver. And I would like to either tell you or remind you that we have a ranking on the website under this link, or you can just go to sunshineprofits.com. Then from the research menu, go to how to buy, and you'll end up with this ranking where we're featuring multiple ways of purchasing and holding precious metals, along with their attractiveness to traders and investors on a 5-star scale. And if you click on a given column, it will rank it in the order that you're interested in. You also have a quick summary at the end, so something you might appreciate given your question. All right, next question. It's actually a comment, but still. PR, with all your wizardry, your magic stick, and the endless stream of rabbits you pull out of your charts. I wasn't sure, but just in case you didn't know this, see the above. There was a link to quite long article, so I'm not going to discuss it in its entirety, but I want to feature the takeaway, and the takeaway is right in the message. So it's where the hedges have placed their bets. They seem to have put the pedal to the metal and gone long on the dollar. You can see that their positions correlate to the outcome, but their positions relative to where we are right now suggest that they are front-running a big move in the buck, dollar bullish. I was looking at some of the smaller cap mining companies yesterday, some of them down 60% plus already. When this correction is over, we get the horns of an angry bull. Sounds fun, eh? All the best. Actually, yes, it will be quite fun to participate in this move, especially that these volatile moves happen so rarely. So I'm very excited that we are about to see it, and I'm just as excited about seeing probably the ultimate buying opportunity for the precious metals sector, for the precious metals, for mining stocks in the following months. So yet another confirmation of the bullish case for the USD Index. All right, DRPR, thank you for your work. It is very valuable to me. I'm investing in gold, mainly silver. I'm looking forward to getting the best long-term entry point for both. If the analogy with 2013 is so strong for gold, as you mentioned, what makes you think that the price of gold price, will not again melt down for months like 2013-15 instead of only 3 months, mid-December? Stock market could also melt out for longer than expected. I am questioning about the firm of the downturn. It is reasonably possible that it could be longer and slower than expected. Your comments are much welcome. Thank you in advance. Well, as always, it is possible. Everything's possible in the market. The question if it is likely. I don't think that it is likely, because I think that that the stock market, just like you wrote in the question, will probably melt up for longer than expected. I mean, I expect it to end up for it to decline for relatively long. But I don't expect precious metal sector to be affected for the entire time. Just like it wasn't affected in 1929, just like it wasn't affected for the entire time in 2008, just like it wasn't affected for the entire time in 2020. And well, we can see it right on the chart also here. Sorry. Yeah, stocks bottomed in late March, but actually gold stocks bottomed sooner. Okay, because they're on the bottom of this chart. And then stocks continue to decline. It's just that was a short-term decline actually, and what we're discussing is long-term. But the markets are of fractal nature, meaning that the price moves tend to be self-similar. So bigger moves are similar in shape to the smaller moves, but well, they're just bigger. So a move that's $100 could be similar to a move that's in thousands of dollars, and instead of it being taking place in over a few weeks, it could be taking place over a few months, but the shape of the move would be very similar. So as you would zoom out and then you copied one chart next to another, the first one, they would look very similar. So the observation from 2000, observation from what we saw in 2000, in the previous periods that I mentioned, tell us that if stocks decline for longer, then precious metal sector and mining stocks are likely to get back up before stocks end their decline. So that's one thing, but that doesn't reply to exactly the question, why exactly 3.5 months? Why? Because of the analogies that I featured. That's why I think it's going to be 3.5 months. Besides, the situation now, the fundamental situation for gold is very bullish. It's very bullish. The amount of money that was printed in the aftermath of pandemic, actually, it's still taking place. That's extremely bullish for gold on a fundamental level. And on one hand, we have slowing growth. On the other hand, we have inflation, so stagflation. Analogy to 1970s, the great bull market that ensued at that time. We have powerful forces that are likely to push the precious metal sector higher, but based on the analogous patterns to the past, gold is still likely to decline in the next several months, but it is these several months that are in the opposition to what be logical, from the long-term point of view. So the cyclical part, or the fractal part, or the technical part, could drive the prices in the short run, in a matter of weeks, in the medium term, in a matter of months. But ultimately, meaning in the long run, the fundamentals are likely to take over and the precious metal sector is likely to move much higher. Will this happen after a really long decline? I don't think so. The money that was printed now, the amount thereof, is much bigger than what we saw in 2013. So that's why I don't think that the situation will be repeated in the long run, but yes, in the medium term, because emotions will work in the same way across different time spans. All right. Love the video updates. Appreciate you always trying to improve services. I think the video is the way to go. What is your view on Shanghai changing their gold future rules to allow us 60% up in a single day without stopping trading? I understand they also think of linking yuan to gold. Do you think either of these things may change your view on gold in the short term? First of all, I don't think that Shanghai changing their rules on gold with regard to the daily price movements changes anything. All right, but gold would first need to be willing to rally that high for this rule to change anything. It's unlikely to take place. I don't see it as a sign of anything, really. I might be wrong. If anyone watching this would like to argue about it or has some arguments for this being very important, I would love to hear about them or read about them, and I would be happy to comment on them. I don't see logical implications that it should change something. I understand you also are thinking about linking yuan to gold. Well, I don't know what they're thinking. I think it's relatively unlikely. One of the strategies for growth in the case of China was to keep the value of its currency low, so that the goods they produce there are priced very competitively, and therefore people from other countries will really want to import them. And linking currency to gold would actually made it very difficult, if not impossible, to keep the currency value low. So I don't really think that's that likely. And even if I don't think it's likely to happen in the near term. So neither of these things changes anything regarding my views on gold with regard to short or medium term. Also, I would like to encourage you to read Arkadiusz Sheron's article, Will Yuan Replace US Dollar and Make Gold Shine? It was published in May 2019, but it's pretty much up to date right now. I'll put a link below the video. But, well, you can also Google it, Will Yuan Replace US Dollar and Make Gold Shine? I think you will enjoy it. All right, next question. Hi Pierre, I appreciate the comprehensive nature of your daily updates. Thank you. I have a question about the interplay of gold silver, the USD, and the 10-year US dollar Treasury yield. It seems to me that if USD drops, Treasuries would then be sold off and yields go subsequently higher. And if the USD strengthens, demand for the USTs should rise, which should push yields lower. This doesn't seem to be the case. In Q1 of this year, USD strengthened significantly, the 10-year UST pushed up, and gold dropped hard into March. I know we've talked about USD gold correlation before and the US 10-year yield gold correlation before. I guess I'm looking for some help on how the trio all interacts together. All right, I will dedicate the entire text part of today's analysis to this issue. Well, most of it. So I don't want to go into the details in the video. I hope and trust that you will find those text comments useful. Okay, and so basically, this is the last question that is market related that I already replied. Actually, I didn't reply, but I told you how I'm going to reply to it, so I think it counts. So to summarize the market part of the video, the outlook for the precious metal sector remains bearish, very bearish. The very short term is relatively unclear, but it's very clearly bearish, extremely so, for the following months, probably also in terms of weeks. It seems that the profits on our short position in the junior mining stocks are going to be much bigger before the decline is completely over. Okay, and be sure to read the disclaimer at the end of the video. Below the video. This has not been investment advice, just my opinions, not directed at any particular individual, just general opinions. Having said that, I would like to do the thing that I told you I will be doing. So I will feature a book, or, well, something interesting that I found somewhere else. Today it will be a book, and it will be a book by Richard Feynman, the Nobel Prize laureate winner. Surely you're joking, Mr. Feynman. Right? This book is truly hilarious. It's a mix of following a genius and getting into their thinking, realizing that he's a very interesting and entertaining fellow that is telling about the stories of his life. This book will probably make you consider becoming a scientist, or it might resonate with your inner scientist, or perhaps you will discover your inner scientist, even if you thought that you had none, because it's really the essence of science, in my opinion. The curiosity that drives all the findings and all progress made in the world eventually. And it's not about being a boring bookworm. It's about being curious about how the world really works and taking action to discover some things. It's highly entertaining. It includes stories of Mr. Feynman's musical career as a painter. It tells you a story how he prepared for his thank you speech for the Nobel Prize, and how he cleverly avoided drinking alcohol, because on the dinner he did exactly what the King of Sweden did, because he didn't drink either. I'm not going to tell you what was the secret. Maybe you'll find it interesting in the book. I'm not going to spoil it for you. So again, surely you're drinking Mr. Feynman. Excellent read. All right, having said that, I would like to first of all thank you for all the feedback that I'm receiving below those videos, and to our email inbox. Almost all messages that I'm getting about the videos are very positive. Some include additional ideas that I could take to improve further. For example, improving my backdrop. My current plan is to add some books over there with shelves, but books facing facing you with the cover, so that you know what the book actually is, instead of just bragging that I have books. Yeah, I do. But I want to actually share some fun or interesting stuff from them. Who knows, maybe you'll then provide me with questions about some books that you'll see over there. As I received also a comment about the painting that I have behind me. Let me maybe put the camera a bit higher. Okay, I will read this comment. Good job. However, I found myself inordinately distracted by the painting of a voluptuous femme fatale behind you. When I was able to pull away, I found your graph work excellent. Yeah, sorry about that, or sorry, not sorry. My muse over here doesn't have a name yet. That's a painting that I won at the art auction, and that was the first art auction that I ever attended. I went there just for the fun of it. My first bid was just for experience of bidding, and I was really hoping that I didn't win, because I was not interested in the artwork being sold, but in the process of bidding. Fortunately, I didn't win. It was sold for about 100 times much more than I bid. But that was also one of the paintings over there, and I really liked it. So I'm not sure if you did like it. Yeah, you did like it, but too much. I might change the painting into a different one based on another suggestion that I received. Let me read it over here. Find a suitable backboard picture to put behind you, seeing as you like to think a bit differently than the crowd. Maybe some cartoon or picture that highlights what you stand for. Or if you prefer something serious, something that points to the power of technicals charting or history repeating itself. That's a great idea. I love it. What I actually want more of to see in the world is people being themselves. So I know, starting with myself, I'm wearing my company gear today, Sunshine Squad. Well, I will definitely try to come up with something that more represents what I stand for, my inner why. By the way, my inner why you can find about it in my bio. It's about sharing knowledge and solutions with people so they can improve their lives. That's why I insist on featuring those books, because, well, that's me being me. That's what I do most of the time where I'm not analyzing the markets. Anyway. And another idea, relax more, smile, tell a joke. I hope I was more relaxed today. I think I will get more relaxed as I record more of those videos. And I did put the disclaimers at the end of the last video, and I shortened them. So thank you for those suggestions. Here's one important message kind of against the videos. Here are the issues that I have with the video. Reading can be done silently. Audio disturbs people around me. And second point, I am in control of text. I can scan parts that I only have passing interest in. I can scroll back up to reread something. I can move up and down looking at the chart and the explanatory text at will. I can come back to a document at a later date and quickly find the item I'm looking for. In short, I'm in control of a web page. You are in control of a video. And these are very good points. Points made, thank you. This is in contrast to many other comments where people wrote that they prefer video over text. So I think it's, well, something for everyone. If I'm going to provide text and videos, I'm still figuring out a way how to provide both, perhaps every other day something else. One day video, one day text, or I might do it depending on the context, and if something needs, I know, if I feel that explaining it on video will be easier than in text, and I might do it. For example, yesterday's text, where I wrote about Evergrande, it was easier for me to write about that than to talk about that. Not sure why though. So I will most likely continue with both, with text and with videos. Things that I can do with regard to the video, or what you could do with regard to the video, on my end, is adding chapters to the videos so that you can see what was described when. And I'm definitely going to add chapters to this video, or somebody else will on my behalf. Something that you could do in case of videos is turning the captions on. YouTube has the automatic caption feature, and most of the time it works really good. I know it's not as good as text. The text is edited, it's polished, it's then being reviewed one more time before it's sent out. The captions are automated. They can work well, they can not work that well, but it is something that can be done. Okay, maybe it will be like the 20-80, so the 20% of effort that produces 80% of outcome. That's one of the workarounds for the audio. Also, one more thing important. If anything urgent is happening on the markets, I'm changing the position in any way, I will still send out a notification in the text format to make sure that, well, and I will keep those messages short so that, well, it's quickest for me to write, it's quickest for me to send out, it's quickest for you to read and react on. So if anything's on video, it means that it's not super timely. And if it's not convenient for you to watch the video right away, you can rest assured that you can watch it later. Also, notifications will even notifications about the videos will include the positions in the briefly paragraph at the beginning of the email message. So you will still first know if anything's a game changer, and then you can plan on watching the video when it makes most sense for you. It doesn't cover everything in 100%, but it might be a solution for most of the inconveniences of the video format, while keeping the positives intact. Oh, and also about the books in the videos or fun facts, I want to point out that there are varying opinions on those. There is one opinion that says also do not promote a book in your analysis. People will tune out. Keep it simple and fast. And in the previous message, it was one of the pros. I like the add-on about an interesting book. And another useful comment, it would have been better if you took 2 or 3 examples from the book that highlight the central thesis. I haven't read it, but I'm guessing that just because you are good at, say, marketing and tech business doesn't mean you will succeed at opening a retail store, etc. So, well, I already commented on that. And of course, there's no one solution for everyone, but it's something that's connected with me as a person that I enjoy telling people these things. And I'm going to place them at the end of the video so that it's easy to ignore them if you're not interested in all that. But I want to keep this, in my way. So something that will be natural for me. Some of you will likely like it. And since it's natural for me, it's easy for me to do, and it's also fun for me to do. So I will just continue to do that. If you're not interested, just you can simply close the video after I end the market-related part. I will mark it, and I will tell you in the video that this ends the market-related part. And also, the previous book, so to kind of answer, provide a follow-up, the book that I featured in the previous video was The E-Myth by Michael E. Gerber, where E stands for entrepreneurship. Entrepreneurship myth is that someone that's good in something, for example, making shoes, that they will be also great, and that it's a good idea for them to start a business that will deal and provide the service that they are good at. So in this case, shoe manufacturing or producing or fixing business. Not necessarily because an example. Baker can make, great products, great bread, and so on. But does it mean that they should go on their own and start their own chain of businesses, or just bakery so that they can produce bread on their own? Not necessarily, because many more skills are required to run a business. It's about marketing, it's about sales, it's about positioning yourself, it's about getting proper distribution, it's about negotiations, it's about handling people, employees, motivating them, and so on and so forth. There are many more skills other than the key one necessary for the business. For example, being a good newsletter writer doesn't mean that one should start the entire website business and create create the entire website just for that. Maybe they could join some other service and provide the newsletter in this way and make a living out of that. For some people, it will be a great idea to start a business using their core specialization in it and run this business successfully. But for some people, it will be a bad idea because they might be best at what they do, but they might be terrible business people. So that's something that's very often overlooked. And people who are professionals in their craft, they launch businesses only to get burned out after a year or so. Most businesses don't succeed, and that's probably one of the core reasons. The people misunderstand how it works. They think that if you're good at something, you will be good at running the business that provides this thing. That's not the case. This might overlap, but doesn't have to. Okay, so that was what that was about. All right, so I think that this is it for today. That was probably, I don't have a timer over here, but that was probably my longest video ever. I hope you enjoyed at least one part of the video. As previously, I would be happy to hear or read your feedback. And well, I invite you to visit, if you're not yet subscribed, I invite you to visit sunshineprofits.com, subscribe to one of our products, or at least consider it. Or if you're not subscribed and you're not on our free mailing list, I suggest that you and invite you to sign up for our free newsletter. It is really free, and you get 7 days of the premium service as a starting bonus. You will easily find a forum where you just enter your email and your first name, so that we don't call you the reader, or so that we can call you by your first name, or whatever you decide to put in this box. So thank you, and signing off for today. Until the next video. Thanks again. Bye bye.